Hey guys, do you want to make money in the stock market but don't want to risk too much money? In this video, we're going to talk about the poor man's covered call option strategy. This strategy allows you to profit from stock price dips while limiting your risk. We discuss the poor man's covered call, what it is, how you can use it to make money in the stock market. We're going to cover what is the poor man's covered call, what types of stocks are best for the poor man's covered call, how to use a poor man's covered call, and we're going to give you a real world example, when to use a poor man's covered call, why we use it, and we're going to compare it to a traditional covered call. We're also going to talk about how the covered call is managed and the risk of using the poor man's covered call as well. All right, what is a poor man's covered call? A poor man's covered call is an option strategy that allows you to profit when a stock price dips, and you're also going to limit your risk at the same time. You'll want to utilize and put on a poor man's covered call in stocks that you think will increase in price. The strategy involves buying a long-term deep in the money call option on a stock or an ETF. It's also known as a LEAPS option. This option will replicate the ownership of buying 100 shares of stock outright, which would cost much more buying power up front to do. At the same time, you're also going to sell an out-of-the-money call option in a near term. When the stock price falls, you can buy back the call option for a profit. If the stock price rises, you can hold on to the deep in the money call option and exercise it at a higher price. This strategy is also known as a buy right strategy, since you're buying the deep in the money call and then you're writing or selling a short-term call option. What types of stocks are best for poor man's covered calls? Some of the best stocks that I find are good for poor man's covered calls are those that pay high dividends and have a history of paying high dividends consistently over time. So a company like Merck, for instance, ticker symbol MRK, is a great candidate right now for a poor man's covered call. They've increased their dividend payments over the years consistently. They also are not too high priced. So buying the long-term deep in the money call option would not be too expensive to do. At the same time, the premium received for selling the short call is pretty high as well, and it provides more income opportunity. Okay, let's take a look at putting on a real poor man's covered call on the Tastyworks trade platform. And we are going to use Merck, ticker symbol MRK. We're going to go to the trade tab on the left here. And if we look out past 352 days or past 1 year, the next one is 557 days, January 19th, 2024. Let's open that up, and we can see the call options on the left side. And let's look at the 85 strike option, and we'll look to buy that. Mid price will be between 1620 and 1655. So we will click right in the middle there at 1635. So that's really $1,635 to buy that option. And we would just go ahead and hit review and send and put that on. Now, after we do that, we will stay on the trade tab, close this up, and then we are going to look at the shorter term. We'll look at 39 days to expiration, August 19th, and we will look to sell. We can either go the 95, 97.5, or 100. The stock's at 94. We don't really want it to be called away. So let's look at, we're going to give it some room, and we're going to collect, it looks like we can collect $1 here at the 24 delta. So it's got a 75%, 76% chance of expiring worthless. We'll go ahead and we will sell the 100 call option for 95 cents. So we'll collect that option premium. Now, if we hit review and send, that will go ahead and place that, and we'll receive that in our account. And that is how you would put on a poor man's covered call on the Tastyworks trade platform. Okay, let's take a look at when we use a poor man's covered call and why we use it as well. So it's a bullish strategy And you're going to put on a poor man's covered call when you want the stock price to rise. At the same time, you want to limit the amount of capital or buying power that you're utilizing on that one specific trade. Why do we use poor man's covered calls? Again, same reason. It allows you to profit when the market's down, when you're expecting the stock to go up. It limits your risk. You're limited to the amount that you pay for the leaps option up front, because on the short call side, you're collecting premium. So the most amount of money that you can lose is that amount that you're paying for the deep in the money call. And lastly, since you're selling the call, you do collect that premium. So it helps generate income for your portfolio. All right, when we're comparing a poor man's covered call versus a traditional covered call, the one key major difference is when we are buying the deep in the money call option, we're replicating the stock. So with a traditional covered call, you would buy 100 shares of the stock outright. So there's much less capital outlay when you are buying the call option, the leaps deep in the money call option way out in time. You're going to save a lot of money on that option versus buying the stock. You will also sell a near-term call option with both the poor man's covered call and the traditional covered call. So in this respect, it's absolutely the same on the short call side. Manage the poor man's covered call. We do it similarly to the way that we would manage a traditional covered call. As long as we still believe that the stock price is going to increase, we're going to hang on to that deep in the money call option that we purchased. I like to buy the option out for more than a year. So typically going out a couple of years like we showed in the example. And this is a leaps option. Once the deep in the money call option gets to within 1 year, I may sell to close that option and then go ahead and buy again out 2 years. And you can almost do this for free. There's very little cost to do that. The near-term call option is managed as we would a traditional covered call. If the stock increases in price and the strike price is breached, we can do one of two things. We can close the entire poor man's covered call, both options, for a win and take it off the table. Or if we want to hold on to the longer term option that we bought, we can go ahead and hold and wait to roll the short call option at around 21 days to expiration. We go ahead and roll it into the next month and sell another short call and collect additional premium. We also can roll down our call if the stock price drops. This allows us to collect more premium and reduce our max loss and break-even point. So we're always cognizant of what our current break-even point is, and we don't want to roll down that call option further than that. Okay, and as with any stock trade or options trade, there is risk with the poor man's covered call. If the stock were to go to zero or decrease sharply, which we're not expecting since we are picking stocks that we believe are going to go up, then you could lose the entire amount that you paid for the deep in the money call option up front. But that's the max that you can lose. So if you were to own the 100 shares up front and outright, and it dropped down to zero or went bankrupt or dropped sharply, you would definitely lose a lot more money than you would if you're using the poor man's covered call strategy. All right, guys. Hey, to conclude, the poor man's covered call is a great way to profit when you believe a stock is going to increase in value. It allows you to go ahead and collect additional premium, and the risk is lowered as well because the max amount of money that you can lose is the amount that you paid for that long call option. So let us know if you've ever used the poor man's covered call. Thank you for watching, and we'll see you in the next one.